Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into today's episode of the Money Insights Podcast. I'm Christian Allen here with the much better looking Rod the Pod Zabriskie. Rod, what's going on, man?
Hey, I am doing great. And I probably say this every year at the exact same time, but I'm getting excited for college football.
You do say this every year. Something tells me you like college football. Okay, I used to be hardcore dedicated college football fan. Now I'm like kind of like, I'm still a fan, but I just don't get into it like in the lead up like I used to back in the day.
Would you say that something happened on the college football side, or it seems like you're really engaged on, especially the NBA?
Yeah, I just changed my engagement. I think my issue is college football is like that short time. And I like that the NBA season goes and even when the season's not going, Rod, it's amazing. You've got just stuff going on all the time. You got trades. There's always podcasts to listen to. So yeah, I dig the NBA. I do not dig the college game. It is an absolutely horrible production of basketball. I can't believe anybody can watch that stuff. It's just terrible. The spacing on it's terrible. Like the time, like all of it's miserable. Even the angles that they shoot them at, it's just terrible. So I can't watch college basketball. I can get into it a little bit once you get down to like Final Four time.
Yeah.
But sorry, not Final Four, just March Madness in general.
After the first round.
Yeah. Well, and of course I've got my team, and if my team's in it, I'm like, okay, I'm good. But by the time my team gets out, which is almost inevitably in the first round every year, I'm kind of like, and then I might get back into it when there's a good Cinderella story. Or something.
Yeah. Now this illustrates the difference between you and me, because I don't dislike college basketball, and it's the scrappy. Like I like watching the guys out there that just they're not the most athletic, right? They're not going to the NBA. But I'm like, why can't
these guys ever dunk it when they're right next to the rim? They're like 6'8", 6'9", and I'm like, if you watch the NBA, those guys are just like boom. Yeah. But these guys, I'm like, you're right next to the rim, just dunk it. I don't know, man. No, I think it's funny. I do love college football though, and people are gonna be surprised. I actually like college football more than the NFL, but I think a lot of that has to do with the fact that I'm in Salt Lake City. There's never been a team close enough to call my own. So like if I had a team, I think I could probably engage more in that. We're turning this into an official sports podcast.
Yeah, you said you wanted to start a sports podcast. So maybe,
I do.
This is your moment.
do. I've thought about starting an NBA podcast for some time. I just keep putting it on the back burner. Sounds like today's the day. Okay, probably not. Thanks everybody for hanging out with us for our 3 minutes of sports talk. We're going to get into a much more compelling subject, Rod. Yes. One that I know people are thrilled to talk about because it's, one of our favorite subjects. We're going to talk about life insurance, but we're going to talk about life insurance in a little bit different way than we typically do. And what I mean by that is we're going to talk about it in the more traditional sense.
Yeah.
Now we're obviously gonna sprinkle in our focal point, right? We oftentimes use life insurance primarily as a wealth creation tool, basically a wealth enhancement, wealth creation tool, right? Life insurance has another purpose, and can I just tell you, as a child of a dad who died at 49 years old, who was not a believer in permanent insurance, by the way. My dad's a CPA, and he was like. He was a corporate CPA. It wasn't like an individual. Like he didn't do a lot of like public accounting in that sense, like tax returns.
Right.
But okay, let me get to the point. I'm getting off topic here. My dad died at 49, and he had term insurance. And guess what? It worked. My mom was able to live the rest of her life like without having to go get a job, and like she basically lived the same financial lifestyle that she would have lived had he been there, or at least something similar, right? Mm-hmm. So I say that just to say, like, hey, we focus on it as a way to build wealth and create all these, really unique benefits, tax benefits. And yet at the core, there's another really important value that we oftentimes miss, or at least gloss over. And that is just that a death benefit is unbelievably valuable to the people who need it at the time that it's there. And in that situation, it doesn't matter what type of insurance, it matters more how much. Yeah. So what we're going to do today, Rod, we're going to talk more about how much insurance is right for each individual. And we're going to hit on a variety of circumstances. So that being the case, Rod, why don't you kick us off, and we'll start wherever you want to start. Maybe we'll start with the reasons to have life insurance.
Yeah, absolutely. And for a lot of people, the question may not make much sense, right? Well, reason to have life insurance? Well, it's obvious, right? The one we think of most is, we don't necessarily think of it this way, but income replacement, right? If something happens to me, my family and my working income goes away, my family needs a way to live moving forward, and so income replacement is the way we term that, right? And we'll get into maybe a little more conversation around how much you should plan to have, but typically we talk about this in terms of a multiple of your income. So if someone says, well, what's the right amount of insurance for my family if something happens to me? And there are people out there who will say, well, 10 times your income is what you should have.
Okay, Rod, can I just say this? I saw this literally 2 days ago. I got sent to my wife saw like something on Instagram, and she was like, oh, this guy is interesting. He's talking about life insurance. So she passed it along to me. And his advice was exactly that, 10 times. And I thought to myself, like, this is such generic trash advice. Yeah. And yet it still gets put out there. It's like as bad as the 4% rule. Hey, just go get X percentage. Like, it's ridiculous. Anyway, Keep going.
Yeah. Okay. So, and that's a great point, because there are a lot of people who use that as just like rule of thumb, boom, 10X, that's all you need, right? Don't even think any more about it. However, some people might be surprised to find out that an insurance company will give you up to 30 times your income. Well, that's a lot.
Why would they do that? That's right? A big difference. Okay. So let's do some math here. So I'm $1 million earner, and so you're saying it's the difference between having $10 million of death benefit and $30 million of death benefit. Here's the question I have for you, Rod. I actually know the answer, but here's my question. Okay. Why in the world would an insurance company allow someone to have 30 times their income, especially when people are saying you'll get by just fine on, 7 or 8 or 10 or 12?
Yeah. Well, the reason is because, let's just say we have a lot of physicians who listen to this, right? Let's say you were just finishing up your residency, you're just getting into your practice, you're 35 years old, and you have 30 years left to work, right? Theoretically, right? Some people might say, well, I don't want to work the 30 years, but the point is that age 65 is generally, right, what we think about at retirement age. And so the insurance company is saying, well, if you have 30 years of work ahead of you, we're willing to give you 30 times whatever you're making right now in the form of a death benefit. Right?
Okay, so wait, this makes a lot more sense. Like, again, It's actually logical. And can I just tell you, insurance companies aren't always logical. But in this situation, it's a very logical translation into how much insurance I can actually get. Because you're saying, okay, I would have made $1 million. And, it's a little different to have all of that at once, right? Granted, but let's say that I'm the $1 million earner, and I go for a 10X death benefit. Here's the question. Is that really going to provide for my family in the same way that that it would have been if I was there? In other words, I want my plan to be rock solid and for it to work no matter what stage of my life something potentially happens. And so again, there is a massive difference between being $1 million earner and earning that every year. Even if I got $10 million right up front, that's still not likely to provide the consistent $1 million for the rest of my life. Right? Yeah, and I think that's the primary point.
And I think the challenge that some people face is they kind of get scared by a big number. Like 10 million is a big number. They feel like, well, man, if my family can't do okay with 10 million, then we're really doing, wrong things here. And yet, again, the logic of it, if at age 35, you now have a widow with 4 kids or something, and you want them to continue with the same lifestyle as they've been enjoying or now kind of getting into, that's not going to do it. Right. So
yeah, and that's the key, right? The question I think you have to ask yourselves is, do you want them to be like, do you want people that you love and care about to get by, or do you want them to be able to like have opportunities, similar opportunities to what they would have if you were there?
Yeah.
Everybody's different, right? But what an insurance company says here, and this is the important point, is that we think that your value, your financial value is a lot higher than 10x. Mm-hmm. And I think that's the point that we want to emphasize.
Yeah. And we have absolutely had professionals that we worked with, and we said, you can get 30 times. And they said, that's exactly what I want, because I worked way too hard to get where I am now to just even think about the idea that someone doesn't benefit from that. If something happens to me, someone's going to benefit by that. Okay. Now,
so we commonly call that human life value, right? The insurance company says that is the financial value of your life. And that, I think, is a much better way. It's a much more logical way to think about death benefit than, just going off like these herky-jerky rule of, large number things that may be enough, but also may not.
Yeah. Yeah. And can I say one other thing? Going back to this kind of getting scared by big numbers, a lot of times what we also hear is, well, I don't want to just make her a sugar mama that's, that's like a magnet to these jerks out there. Correct. Yep. That's a magnet to a jerk out there that's going to come in and ruin my family. Right.
Yeah.
And so I'll say this, there are situations that's one of the reasons people say that, is because there are situations out there where that happens. But you can do other planning around it to protect your spouse, your kids, so that doesn't just happen, right? You put a trust in place. No money goes into the trust. Can't come out of the trust except in certain circumstances. And so you can do some things if that truly is a fear of yours.
Yeah, that's a good point. And one of the things I like, and sometimes see, Rod, is that some people get excited about their human life value, right? And they're like, heck yeah, I'm worth every cent of it.
Absolutely.
And I want to take advantage of it. So when you're thinking about how you want to deal with life insurance, maybe transition away from even needs-based planning and focus on optimization, right? Think of it this way, if you're already in a strong financial position, you're past that place where you need to be just doing the minimum. Now you can create the maximum value, or what we would say the optimum value is. Now, the question might be, okay, do I need that much insurance? Well, maybe not, but do I want it? Does my family's life look better? Does the legacy that I leave look better if I'm able to do that? And then the question is like, well, what am I having to give up to do that? And I think what we're going to show here is that most people will give up very little, if anything, and most likely gain just by maximizing or optimizing their human life value and getting as much insurance as they can get, rather than just trying to get what they feel like is, a need situation. Now, there's one other important point here. You have to believe in life insurance as a value, right? And of course, we believe it is a value in multiple ways. The death benefit is the starting point. So even if I just believe in it as a death benefit value, I get a 20, 30 year term that gives me my 20 or $30 million of insurance. Like, that's still a much better solution. And maybe it costs me, $5,000 or $6,000 a year. You know what I mean? Probably, maybe a little bit more. Maybe it's $10,000 a year. But if I'm $1 million earner, and again, that's just the example I'm using, like, it's just the value is totally there, right? Okay, sorry, that's a little bit of a rant.
And just maybe one last thought is, as you may expect, as you age, the amount that the insurance company is willing to give you goes lower, right? So if it's the 45-year-old now, then they'll give you 20 times, right? So
logic, it's weird. There's actually good logic. They're like, hey, what do you earn today? And by the way, like, I would say if it was really going to replace an income, it would have to even be higher than that, right? So So like, it's still not I don't want to say perfect. I think it's probably sufficient, but I think about my income. How many people are like, okay, I'm 35, I'm making whatever I'm making. I think I'll be making the exact same amount of money at this time 28 years from now. Well, the insurance company is saying, okay, we recognize that we're getting a lump sum of money, which then we can invest and do something with. And that is different, right? Yep. And so I think what's happening is they're offsetting those two merging situations to get something that's like reasonable, right? Yeah. Anyway, so for me, the human life value calculation just speaks to me in a lot more logical, sensible way. And I think if you're a wealth builder, like if that's like your focus, if you're like trying to create generational wealth, like life insurance is awesome because it lets me do all of the stuff I'm doing over here and still do that regardless. Mm-hmm. Like it's just like an added benefit. Okay. So Rod, let's talk about how, some of the different ways that we're using life insurance and get into some conversation beyond just the basic term insurance death benefit need.
Yeah, right. Because talking about term insurance is really easy. Like you said, you put a couple of grand down and you have a lot of insurance, especially as a 35-year-old, right? But we obviously talk about, let's call it the strategic use of the cash value. And there are a lot of different forms of that. The easiest part is the investment optimizer or the capital avalanche strategies that we promote. And it's a little bit ironic because when we set them up, we tell people, hey, we want to keep the cost as low as possible, which means we want to get the insurance as low as we can, right? But here are the benefits, the other reasons why you would want to do that. But the fact is that it does provide a pretty significant amount of insurance. Again, if that's that 35-year-old and they're putting in $100,000 a year into an investment optimizer policy, they're going to get maybe $2.5 million of insurance as a starting point that grows as they continue to put money into it, right? As the cash value grows, the death benefit grows. So it's not an insignificant number. Now, it's not getting anywhere near the 30x, right? So you might say, okay, great, that's one piece of it. And then I add term to make up the difference. And that is a great way to approach that. A lot of people assume because we deal in the permanent insurance world that we dislike term, and couldn't be further from the truth. We want to make sure that we're optimizing the money you're putting in for the strategy in the way that it grows the cash value. But we also want to make sure that you're taking care of those who need you, right? Who are relying on you. And so having the right amount of insurance is absolutely critical.
And that's why I brought up the example of my dad. Like, our family didn't care what type of death benefit. Like, it was the same amount of money regardless, right? So it ended up being really important. And I think that's an important message. The type of insurance, when we're talking about death benefit, is far less important than just having the right amount.
Yeah,
right.
For sure.
Now, to your point, though, one of the great things is if we can plan and we can bring like all those pieces together, I can get more value, right? So I might use the investment optimizer or capital avalanche. That's going to provide some level of death benefit just by doing that. And usually like pretty significant, right? So now it's just a matter of planning and preparing, like creating that gap between what those two or those things are providing me and what's the optimal amount of insurance.
Yes.
Closing those gaps is the kind of the key.
For sure. Now, having kind of walked through that, there are other reasons why people use cash value, strategically use insurance for the cash value. One is retirement income. We often talk about that again, especially with capital avalanche, but there are a lot of people who, and for that matter, even in the investment optimizer, right? You're building value inside of the policy that can later be used as a source of tax-free income. Liquidity is a big piece as well. For the same reasons we like the investment optimizer with the life insurance, because it provides more value than I can get from just using a bank account as my opportunity fund. If I have liquidity sitting around, whether it be for my emergency fund or I'm a business owner and I need business reserves, and we most often find people are just dropping that into a savings account, maybe a high yield savings, a money market type of thing, but a policy like this can be really good for that because, again, it provides that predictable growth with similar returns, even to what people are earning today. You get the same thing inside of a policy like that. And the tax benefits with it. You're not getting a 1099 at the end of each year for the interest that you earned. So, really
from an interest rate standpoint, this is an interesting one. So just really quick, a side note. I always say this: life insurance is designed to beat, like the cash value is designed to beat interest rates, but it's designed to be interest rates over long periods of time. So the typical interest rates will have these like ebbs and flows. Life insurance will have like just a very slow slope going up and down. And so it's a lot more predictable, but there's no question that over a long period of time, I'm going to get significantly more value, even just sitting in cash there versus trying to like maximize in CDs as an example, right? I might have a short period of time where CDs give me 0.5% more, right? Maybe I get 5.5% in a CD, but like I can still generate, like over the long haul, chances are I'm going to generate much better than the 5% return. And of course, I'm going to get the death benefit and I'm going to have all, the tax benefits and all those kind of things. So from a value standpoint, it's for sure there.
Yeah. And for that same reason, a lot of people use it as an alternative to the bond portion of their kind of traditional market portfolio. And you think about it, what are the bonds providing for you in that? Like you think of like an 80-20 type of portfolio, right? 80% in stocks, equities, 20% in fixed income, which most people go with bonds on that. And again, this goes back to your point. The return on those bonds is going to go up and down. And especially if I'm literally buying the bonds, I'm committing to a period of time. If it's a 5-year bond, it's 10, 20-year bond, I'm going to either commit to holding that bond for a long period of time or selling it at a discount if at some point I'm like, oh, well, man, interest rates are going up, but therefore the value of my bond went down. I have to sell it, but it's at a discount, right? The whole kind of Silicon Valley Bank issue that they ran into, right?
It's kind of like having, I'm doing this on the fly, Rod, so hopefully I'm accurate. It's kind of like having, it's like a bond alternative with a put option on your life.
Wow.
What do you think? A bond alternative with a put option on your life. And that's what it is. Like, because again, like I want to emphasize the death benefit, the cash value. It's awesome. It'll do all those things. But like the fact that I get the cash to do the same things I'm getting as same or better than I'm getting in CDs, money markets, etc. And I'm getting that death benefit, the put option on my life, right? Like that's the value proposition is just so much bigger than what I'm getting from these cash positions and CDs and that kind of thing. That's the main thing I wanted to emphasize. So when we're talking about using life insurance in various stages, you've talked about IO, retirement income, liquidity, bond options. Rod, we got to talk about business planning.
Yeah. And now we're getting back into more of the death benefit. Okay. And now it's actually, it can do both. Initially, we're going to talk about death benefit. We'll get back to the cash value. For business partners, life insurance is a critical part of a buy-sell agreement. Well, what's a buy-sell? If you and I are partners, one of us passes away and the other is now running the business without the partner and doesn't want to just have to be in business with the widow, then having this life insurance provides a way for the surviving partner to have the capital to buy out the now deceased partner's family so that there can be a clean transition, clean kind of moving forward of the business without problems, just the inherent
problems.
Can
I also just say a clean moving forward of the business and the family of the person who passed, right? So if you and I are in business, like both sides have an issue, right? The business has an issue. It's got to continue to run and you can't have one person doing all the work and getting like not the same pay. Like that doesn't work. But on the other side, like they likely don't have the experience, know-how, understanding to like provide real value and run the business. And so they're just and they may not have, they may not be able to, the business may not be able to produce the same amount of revenue. And so now the family's in a tough spot. So this just provides a way for everybody to be made whole. The business, the surviving business owner, and probably most importantly, the surviving spouse and the family gets a clean break from the business, and they can actually have like liquid cash flow to continue to go do their thing.
Yeah. And what's interesting about this one is that this is a completely separate conversation from the income replacement we talked about a minute ago. So hopefully the family, the deceased partner,
hopefully they have, hopefully they've
income replacement. But what this does is, we were talking about the value that comes from having my income now and in the future, right? That goes away if something happens to me. What we're now saying is there's a value inside of the business, right? The business is worth something. And again, if it's 50-50 partners, you own half of that. And the life insurance provides a way for the family to get the value of the business out in a very clean, liquid way. And so it's both, right? You can have life insurance. You can get the 30x of your income and even get more insurance as it relates to getting that value of the business.
Man, Red, you were just getting people so excited. You can get more insurance.
Woo! Amazing.
Sign me up. Sign me up.
Okay. Well, if you call now, there's more.
Sweet.
Because.
Okay. So, sorry. Because why?
Well, inside the business, there's also what they call key person insurance.
Okay. So you can get lots of insurance if you're a business owner. Lucky ducks.
Yeah.
Now I say that jokingly, but in like a lot of ways, that is a significant value. So, okay. So buy, sell. The next business planning purpose is key person, right?
Yep.
Key person, just most people know what it is. But if I have a key executive on my team that is producing a lot of revenue, that would hurt the business if you were to lose that person, that would be your reason for having key person to come in and make the business whole. If that situation were to come, business transitions, like that's a huge deal. There's a massive problem in America, from my understanding, in this business transition space. There's we've heard for years and years about all the baby boomers, right? This baby boomer generation that's like the biggest generation. Well, they're retiring, and many of them don't have transition plans at all, right? Mm-hmm. So the best thing that you can do is you start thinking about this early. Now, I'm not suggesting that before you have a business that's moderately successful, that you should spend a lot of time on your transition planning. Probably not the time, but you want to have at least some key elements in place, like your buy-sell agreement, that kind of thing. Mm-hmm. And then as you continue to grow and develop and get more successful, it makes more sense to spend more time in some of the business transition planning, and life insurance can obviously have a big impact on that. Yep,
absolutely. Okay. And then the last one we're going to talk about in the business planning is executive incentives. So we talked about having a key person policy on an executive. Well, that's protecting you if something happens to them, you as the business, if something happens to them. But life insurance has some really unique planning opportunities for the more likely scenario is the executive survives, they retire, and you can have this package that you hand to them at retirement inside of a life insurance policy that provides this tax-free income, and along the way was providing some death benefit coverage for the business and or the family as it goes. So again, we don't want to get into too much detail on this, but the point is just that from a both cash value standpoint and death benefit standpoint, these executive incentives are pretty cool.
Okay. Yeah. Super important points. So now we've talked about the individual, and when I say individual, non-business is what I'm saying. So individual needs for insurance. Now we've talked about the variety of business needs for insurance. And next, Rod, let's talk about the value of life insurance specifically for estate planning.
Yeah. We're going to talk about three things here. The first one is for the estate tax, right? So if you're fortunate enough to have a large enough estate that when you pass, you're above the lifetime exclusion as it relates to the estate tax. Now your estate, your kids basically have this estate tax burden. By having life insurance as part of what you're passing on, part of your estate, now they have liquidity to pay those estate taxes. They don't have to sell stuff off to have the money to the 40% estate tax they have to pay, which is the federal. If you live in a state that has state estate tax as well, it's obviously bigger than that. So that's a big one. The second one is liquidity in the transfer of the estate. And in this one, we most often talk about it in terms of balancing against non-liquid assets. Again, you don't want to have to sell assets, sell a portion of your estate portfolio or your real estate portfolio just so that the kids have enough money to maintain the overhead costs associated with running that portfolio. You have the liquidity for that. But the other thing that we don't talk as much about is it can equalize the assets going to the kids. And this obviously is very much dependent on the individual, kind of what they have, what they are passing on. But let's say you have a business owner who gets, maybe they have 4 kids, they get 2 of the kids involved in the business. And at the time that now dad passes away, 2 of the kids are in the business, running the business. It makes sense for them to inherit the business. 2 kids who are not in the business have no interest in being part of the business. They don't care to inherit anything from the business. Well, now what do you do, right? If that represents 75% of your net worth, well, life insurance can be a really good way to equalize the estate that you're passing on to the kids.
And finally, if you're charitably inclined, life insurance has some kind of cool ways that you can tap into, both providing value in terms of charitable donations and creating value for yourself while you're living. So it's not one of those things like that you normally do something charitable to get the tax benefits, but if you're charitably inclined, you can also get some really strong tax benefits. Does that make sense? So anyway, but your point, my point here is really just that life insurance is a really powerful element of that for all of the natural characteristics that exist inside life insurance. There's tax benefits, obviously the death benefits tax free. If I put it in a trust, like I can do some more things with it. So like there's just a lot there. It makes charitable giving and life insurance a really nice fit. Okay, Rod. So we've talked about it on a personal level, business level. We've hit it on the estate planning side of things. We've talked a little bit about the types of life insurance already, and maybe touched on the some of this element of we're using. Okay, let me back up. We talked about the need for a death benefit. We talked about human life value. And we've even touched on a little bit of this idea that using the Capital Avalanche or the Investment Optimizer has death benefit and therefore is creating something. But we're going to bring those 2 points together and try to help make a little bit more sense of it for people, especially if you're an existing client, you're wondering okay, well, what does this look like for me? This is a good way to kind of at least get an initial gauge. Before we do that, let me talk about really quickly the types of life insurance, and then you can talk about how much insurance you can expect to get from the Investment Optimizer or Capital Avalanche, depending on what you're doing with them.
Yeah.
Okay. So everybody knows what term insurance is. I don't think I need to rehash that. We're going to skip it. Permanent insurance comes in 3 forms, basically: whole life, index universal life, variable universal life. I'm not even going to spend time on them. If anybody has listened to the show at all, they know what those are. The fourth one is that you have a survivorship option. They call it a second to die or survivorship, which just means that the insurance death benefit is on both people's life. If my wife Heather and I own a survivorship policy and I pass away, now the death benefit is just on her. Once both of us have passed away, that's when the death benefit pays out. It's a lot less common today to use survivorship policies than it has been in the past, but they still exist, and they have a place specifically in the estate planning world where it's really, I just want to get the least expensive death benefit I can possibly get, right, for my buck. And obviously the insurance company looks at that and they say, well, the chances of 2 people dying early is less likely than the chance of 1. Therefore, there's value there. Okay, Rod, I've hit on the types of insurance. Is there anything you want to touch on before you get into probably the more important point, which is how much to expect or how much insurance I can expect to be getting by using the investment optimizer? And then what's the best way to take it from there and make sure I'm filling in the gaps?
Yeah. So let's hit on that. What's interesting is when we talk about investment optimizer, capital avalanche, we always talk about it in terms of funding. In other words, how much money do you want to be setting aside to using in your investing with the investment optimizer? Or how much do you want to be setting aside for this future retirement income inside of the capital avalanche? So from a funding standpoint, I broke it out, and it depends based on age, right?
Sure.
Because we're optimizing to grow the cash value, the costs are as low as possible, therefore the insurance is down. But it wouldn't surprise you to know that a 30-year-old is going to get a lot more insurance for the same level of funding compared to a 40 or 50-year-old, right? So if we think of it in terms of if you're in your 30s, how much funding am I putting into the policy to create $1 million? Which it's going to be about $40,000 of funding in the investment optimizer policy and or capital avalanche policy will create about $1 million of insurance. As a starting point, I mentioned earlier that number is going to go up as you go on, but that's where the initial number is starting. If you're in your 40s, it's about $50,000 worth of funding per million. In your 50s, it's about $65,000 of funding to $1 million of death benefit, and in your 60s, about $85,000 of funding to $1 million of insurance. Okay.
And why is that important, Rod?
So basically, what you're saying is, if my target amount of insurance is whatever, 10 million, and I'm funding, whatever, in my 40s, I'm funding $100,000, that creates about $2 million of insurance as a starting point. Then if I'm going to make up the difference, then I need to make up 8 million of term insurance to get to the right number to take care of people who are counting on me.
Okay, so you jumped the gun on me, Rod. You already moved into this making up the rest in terms. So I was going to say, all right, now I've got my policy in place. We have hit on this earlier on, but basically what we're saying is the most effective way to plan from a death benefit perspective, if you believe in the concept of using life insurance as a wealth creation tool, you can back into those numbers, right? You get the death benefit. So we back into them because, again, our focus isn't using life insurance in that specific situation as a death benefit. That ends up being an ancillary benefit that we get with it, but the focus is on enhancing the return of our investments, right? So, but what I've done is I've gotten that ancillary benefit. And to your point, Rod, now I've done it. I've got a few $1 million in death benefit, but there's some important points there that I want to emphasize. When I use money from that policy, the death benefit does lower, right? So if I've got, and I have to make sure that I'm planning for that. So it's not as if, even when I start with an initial death benefit, it's not as if that death benefit, assuming I'm going to use the money in it to now, capital avalanche looks a little different because it's just going to sit and bake for years. But if in the investment optimizer, I'm pulling money in and out of it to invest actively, then that actual death benefit is going to fluctuate. The point here is the optimal way to do it, like Rod said, is to just simply add term insurance to make up and get to the number that's appropriate for where you need to be and where you feel comfortable. Really, really simple. Now, we would recommend, especially if you're like someone that believes in the concepts and understands how to use the investment optimizer, how to use capital avalanche to build wealth, we would recommend using convertible term, which just means that I can maneuver it over time. I can change it to permanent insurance. I can basically, without going and doing any underwriting at a future point in time, I can make that term insurance become permanent, whole life, IUL, whatever, right? Mm-hmm. Yep. And the value is, of course, I can lock in my rates when I'm young. And so when I make that transition over, whether it's 2 years or 10 years, I've got that locked in, optimal rate. It changes based on age, obviously, but that rating could be locked in, and it doesn't matter if you're sick. It doesn't matter if you've had, health issues. Like, you've just got that locked in, and there's obviously a huge amount of value to that. And the other thing that's really valuable there is that I can just kind of convert as I go, right? So one of the questions that people ask when we get into the convertible term conversation is, well, is it an all or nothing thing? And the answer is no. I can have several $1 million of convertible term and say, hey, I want to start putting another $50,000 in. I don't have to convert all of it. I can convert a piece of it, Anyway, so there's a huge amount of value there. And so like, if I were telling people to do it, like, I guess I do tell people to do it. I'm going to tell you, do it this way. Get the amount of death benefit you're getting from your investment optimizer, Capital Avalanche, fill the rest in with convertible term, or at least a portion of it convertible term.
Yeah. And what often happens is we're doing the underwriting on the front end anyway to create the investment optimizer Capital Avalanche policies. So we'll complete those. We'll have that final conversation of, okay, therefore, what kind of funding level are you going to do? That creates X amount of insurance. And because you've just gone through that process, it's really easy to then tack on the convertible term at that point in time. So you say, okay, well, this is how much insurance I need, or this is how much, say, for example, in the Capital Avalanche, I want to stack policies for the next 8 years or something. How much insurance do I need? How much convertible term do I need to be able to convert into all of those future policies? So those are a couple of different ways to approach it. But the point is, you've already gone through the underwriting process. Let's tack on the convertible term while we're still in that moment. And then now you have qualified for that insurance that you need for taking care of your family and for any anticipated conversions you're going to be doing.
Well said, Rod. Well said. Now for our recap. Okay. This is the important part. So to start off, we established some important elements. First, we established that the NBA is superior to college basketball in every way, right? We established that. We also established that college football is better than the NFL. So that was good. But then, Rod, we moved into, the not as important stuff, just kidding. Okay, really quick. We talked about the reasons to have life insurance. We talked about the types of life insurance. Maybe there's reasons. Income replacement. That's the core and first reason to have life insurance, period, end of story. I genuinely believe before you do the IO or CA strategies, like you should just have death benefit. Like you got to cover your family for the needs they have. The nice thing is you can do all of those things in conjunction. They don't have to, they really should just be done together. That's the best way to do it. We talked about business planning, buy, sell, key person, etc. We talked about estate planning, types of life insurance. We talked about convertible term, Rod. What did I miss?
I think you got it.
Game, set, match. Okay, well, this has been fun. Sorry for everybody for having to talk about what's a painful subject. I do get that life insurance, just by the nature of being life insurance, isn't a very fun subject. You have to think about dying. Nobody likes to think about death. So I get that. But our hope in this episode is that we've at least brought up some thoughts. Like if you're one of those people who maybe you're already doing the permanent life insurance stuff and you feel really good about that, keep doing it. But it might be one of those wake up calls like, oh, if something were to happen, maybe I don't have that taken care of. So again, our hope is that you can find the optimal way that makes sense for you. And at the end of the day, we want you and your families to be ultra successful, build wealth like crazy. And if something happens, we want you to be protected in that situation. Okay. Thanks everybody for hanging out with us today. And we'll see you next week.
Thank you for listening to the Money Insights Podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights Podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.